Hi folks, what we're going to look at in this video is Fibonacci retracements, candlestick patterns and how to use these with support and resistance in our trades. We've got Euro USD on the daily chart here, and what I'm going to show you first of all is how to look for trends, how to see what's going on, and how to first of all look for retracements. So looking at this chart in front of you, you can probably see lots of trends. So I'm going to mark up the most obvious one first of all, and then I'll show you how that trend is composed. So using my line tool here, I'll mark the trend in, which is obviously the biggest one there that you can see on the chart. It's that channel there. In an obvious uptrend. So why is this a trend? Well, a trend is formed when you get a succession, in the case of an uptrend, of higher highs and higher lows. So we'll get those marked on the chart now. Right, so here's that trend and how it's comprised in detail. You can see here you start off with a low, you got a higher high, obviously this is higher than here, higher low, higher high, higher low. Then we topped out just here with all these wicks. It had for some reason trouble getting through this level, and it dropped down and gave a lower low, which may have, told a lot of traders that it's going to start to reverse there. Obviously all this stuff to the right, we can't see this at the time, so you may well think that's going to drop down from there. It didn't. It bounced out of there, it made a higher high, another higher low, another higher high, another higher low, and eventually up here at this higher high the price reversed to this lower low, lower high, lower low, lower high. What you'll notice within this big trend here, this big uptrend, is that there are smaller trends. There's one just here, look, going up here, another one here, another one here. Between every single low and high, it's a trend. And then when the price comes down and forms this higher low, in the case of an uptrend, this is a retracement. This is what makes a trend. So you have a smaller trend within a bigger trend, then a pullback, then another trend, and another pullback. Price will never go straight up vertically. Well, it might if a bank intervenes, but it will always go up in these kind of waves or zigzags like this. It never ever goes up in one line. What we try to do is we try to judge when a pullback is going to occur, where the pullback is going to happen, and use candlestick analysis to guide us into that trade to continue with the underlying trend. A great tool to use on these retracements is our Fibonacci tool. It's called Fibonacci retracements. So what I'll do now is I'll put a Fibonacci tool on each of these lows to highs and see if any of the retracements ended at a specific range. Okay, so here's our first Fibonacci retracement from there up to that high there. You can see I've taken off all the other retracement levels apart from 50% or 61.8 because these are the only two we need. What you do now, you should draw a box between those two lines, just like this. Okay? And take off the Fibonacci tool. And then we'll do that for the next higher highs and higher lows we've got on the chart. Right, now here's the boxes on the chart. You can see here this low to high retracement comes into this 50 to 61.8 Fibonacci box, and the price bounces. So it bounces from here, goes up to the next higher high, comes back down, doesn't reach it on this one, but then it forms up into this level here, where it comes down and it hits the box again here, forming this low just here, into the 50 to 61.8 box again, and the price bounces back up to this new high, and when the price retraces back down here to the 50 to 61.8 retracement of this move, it bounces again, and then when the price bounces up to here, it doesn't come back down immediately to this higher low, it doesn't come back down, and when the price eventually does come back down, it crashes through this 50 to 61.8 retracement box, fibo retracement box, and then the price started to reverse, or the price had reversed here, but obviously you wouldn't have known about it at the time. So what you do now, obviously, as the price has rolled over, as you can see on the chart, this is obviously all in hindsight, and we don't know this is happening at the time. All you can do is you can watch for these zones being broken like this. We look here, you can see it bounced out the zone, bounced out the zone, bounced out the zone, but this one here broke straight through it. So you didn't see any reaction at this Fibonacci box, so that's a good sign that the actual price trend may be reversing. It formed this lower low, so I'm just going to pull that box off there so I've got some room on the chart. And what we'll do now is we'll draw a Fibonacci retracement from this higher high to this lower low. Obviously this is a move down here, so let's put that on the chart from here down to here. Drawing our box. Remember, this is the secret. It's this box. It's not using just a level like these lines, 50 or 61.8. It's actually this zone. This is the secret. So now we'll pull off the retracement, and there you can see the price reacted out of this box, the 50 to 61.8 Fibo box. So the price came down here, pulled back up here, and then bounced down out of it. Let's just do the next one. So we're going from this lower high down to this lower low. See how we did on that one. Draw another box. It all gets a bit complicated when you've got all this on the chart, so you know, I can draw the boxes on the chart, and then I can pull the Fibonacci tool off. So here it came down here, tracing down here, hit this box, and you got a response down out of this box to continue with this downtrend. So that's how you get the zones and the retracements and everything when you're looking at trend trading, and how to use your Fibonacci tool, in my opinion, in the most effective way. The next thing we need to look at is how to enter the trades when you see a situation like this into the box. What do you do, or what don't you do? What you basically use is your knowledge of candlesticks. You can see here we came down to a 61.8 retracement, or this 50 to 61.8 retracement box, and then it hit into this box, and then the next candlestick, obviously it bounced here, it couldn't get through, there wasn't enough selling pressure to take this down through the box. And then the next candle you see is this big green candle here. Now this green candle is known as a bullish engulfing candle. It is a candlestick pattern candle, and it requires a couple of things. It requires that this candle, the actual candle that the bullish engulfing is named after, engulfs the previous candle. So it's two candles, and also you need a trend before it. So this is a trend, this is a downtrend coming down here, and then this candle bounces out and gives you this nice bullish engulfing candle. So that's the first thing you need to be aware of. You need to be aware of your candlestick patterns. If we look at this one here, this is more or less a bullish hammer. It's not quite a perfect bullish hammer, but it is in fact a bullish hammer. And this again is a bullish candlestick. It's a standalone bullish candlestick, but it does need down movement preceding it for it to signal that. If it's at the other side, like this one here, see this candle here, it looks like a hammer, but this is actually a hanging man, and this signals a reversal, but that's something else. But from the point of view of this video, this is another bullish candlestick, this one here. And then you can see when it retraced back into here, you had yet another bullish candlestick just here, and the price shot out of it there. What did we see here over on this side? We got a reaction out the box, but there wasn't really, this isn't really what you'd call a bearish candlestick, but there was a wick coming out of the box. And this last one here, almost what are called shooting stars, but not quite. But there was reaction out the box. Right, let's show you what not to do when you're trading these retracements. It's very, very tempting to put a limit order in at these levels. But don't forget, we're using a box, so we don't know exactly where or if the price will stop at the box. So it's very, very tempting, and it looks very, very nice to put a limit order in here. But that isn't the way to trade this. You should be using price action, which involves watching your candlesticks, learning about how the market reacts, and trading with, you know, respect for the market, not just throwing in limit orders, because pretty much guarantee you'd have been watching all that happening and thinking, right, great, I'm up here, I'm going to do this when this price here retraces into here, and look what happened, you got totally thrown out the trade because it went the other way. It carried on down when you expected it to bounce. So the way to trade this is not with limit orders, but to trade it using candlestick price action. So you wait for these wicks to appear. You wait for the candles to close and show you wicks. And what this has the effect of doing, this has the effect of obviously showing you that there's possibly a reversal happening here. When you get the wick, what happens is the price comes down here, comes all the way back down to here, then closes back up here. So the price comes down here and reverses back here and then closes, and then you get that in this case, this bullish engulfing. So what these wicks do, they give you a position to put your stop loss. So in this particular case, your stop loss will be just there, because you know that if the price comes back over here, then this zone is no longer valid. So it's very important that you look for these wicks on these boxes to give you a place to put your stop loss. In this particular case here, I put this box back on the chart. It's the retracement from this move here to this move here. The price just crashed through it. It didn't show any sign of reversing. There was no bullish candlestick out of here. If you look at this, there was a bullish candlestick here, bullish candlestick here, but here there was no bullish candlestick. If you'd put a limit order in there, that would have stopped you out, giving you a nice loss. So that's how you trade with these zones. After you've put your Fibonacci tool on each of these moves, from low to high in the case of an uptrend, you put the zones on the chart and you just wait. You be patient and see if the price comes back into the zone and gives you a proper candlestick pattern away from that zone to indicate to you that the trend that you're trying to get into is actually going to continue and not reverse like it did here. Something else you need to be aware of when you're trading this method is a little bit about support and resistance. Let me just put a line on here and show you what I mean. Look at this line here. Now, as the price came up here, it hit this line, and then the price dropped, which means that this line here is resistance. The price couldn't get through it, and the price dropped, with obviously a shooting star candlestick there as well. When the price came back up here and it retraced back into the 61.8 to 50% Fibonacci box, look where the price reversed at. Pretty much exactly on this line. This previous resistance here has now become support. So these are the extra things you need to be aware of when trading a trend using support, resistance and Fibonacci. Look for instances like this. When the price rolls over, put a line in, then put your Fibonacci tool on, and you can sometimes forecast where 61.8 to 50% retracement is going to be. Or if it does come down to here, this is a good place for you to take a long trade in the case of an uptrend when it reverses back here. So as you can see, put these lines on where the price rolls over, and then check to see if when the price comes back into the 61.8 to 50% retracement zone, if that line has now become support when it used to be resistance. So that's basically how you use support and resistance with this trading method, which is using trends. Don't forget, if you're a member to the website, you can also bring up this CandleStick Alert module. The Alert module alerts you if there is a candlestick pattern that you're monitoring for, on whichever time frame you're watching for, on whichever pair you want to watch for. Just here you can see you can manage your time frames in here all the way down to the 15-minute time frame, or just switch them all off and just monitor the 1 day. This will tell you if you get a pattern that you're looking for, and basically saves you having to chart watch all day long. You just listen to this, put the enable sound on, and you can walk away, and when you get an alert, you can then check your charts rather than having to do all the chart work first. You just wait for this alert and then jump on the charts. Another thing this module is great for is backtesting. If you want to find all your daily candlesticks that have happened in the past, just do this, and that will show you a good selection of previous daily candlesticks, and then you can use those and refer back on your charts to see what happened and what levels those candlesticks alerted at on your daily chart. If you just want to see, I don't know, perhaps 1 hour, you can do the same just there. So that's just 1 hour candlesticks. So it's a great way to backtest as well using this module. So that's it for this video about Fibonacci, support and resistance, and a look at our candlestick module, and I hope you found it helpful. Don't forget, if you like what we're doing here, please click the like button. If you've got a question, send us a comment or subscribe to the channel. Thanks for watching, and we'll see you soon.